Hi, this is Greg. On this channel we talk about business and investment. And on this video we're going to be talking about how to get rich from none other than, yes, that's right, the tech wreck. Welcome to the tech wreck. Okay, so if you've been conscious over the last several months, and if you have been following the market, you would know that the market has come under selling pressure recently. And we have been talking extensively on this channel, if you're new to the channel, about how the bond market has been influencing the stock market vis-a-vis the long end of the curve going up. It reached last week 1.6%. And back in August it was 0.5%, so there's been a tremendous increase in yields on the long end, and that has been affecting the stock market negatively, especially recently, as there's been a very sharp run-up in rates. Now, just to review a little bit, this run-up in rates, according to my views, is a combination of the vaccine coming in and a lot of pent-up demand resulting from the economy opening up again. The economy opening up has been accompanied by tremendous fiscal stimulus by the Congress. And in fact, the Congress is on the verge of approving another $1.9 trillion of stimulus that is going to, in many cases, people that don't really need it, and in other cases to bail out the blue states from either shutting down their economy or that and a combination of past mismanagement of their budgets. This is a Democratic wish list, and it is a slush fund, and as what I said on the last video, a porkathon, which I attributed to one of my subscribers. But anyway, I digress. This is a stimulus package of $1.9 trillion that's going to be flushed into the economy. And those two factors, the money coming in and also the economy opening up with the vaccine, is going to cause, in my view, the economy to overheat and raise inflation, which is what I believe the long end of the bond market is discounting. So one of the results of all this is that the extremely high bubble stocks, I call them, or tech stocks, and tech stocks are not the only overvalued sectors in this market. Literally everything is overvalued, but the tech sector extremely so. And you have seen many of these stocks sell off, in some cases, in a rather brutal fashion. So in this video, what we're going to do is we're going to take a look at what's happened in the market, and I am going to come forward and recommend 5 specific strategies as specific stocks, and I'm going to tell you exactly where I am going to be buying them and where, I would recommend that you would too, although I'm not giving you financial advice. You have to do your own research. But you will see what I am doing and how I look at these things and my reasons for why I think they could make you rich in the long term. Okay, so with that background said, let's take a trip down memory lane and look at these individual stocks, and let's go to my screen. I'm going to share my screen with you right now. Okay, so here we are. So what I am going to do is I'm going to go through my 5 specific recommendations. I'm going to tell you where I would go into these and what my rationale is. I'm going to go through all 5, and then after I go through all 5 in terms of the price action and the technical analysis, then I will have some more comments to wrap things up. Okay? So the first one I wanted to talk about is one of my favorites, and I think if you watched this channel in the past, you would know I like Intel. Okay, and so here is Intel. I'm in my trading account now, and you can see on Friday it closed at $60.74 a share. Let's take a look at the chart. Oh, that's not the one I wanted. I want to go back here. Let's take a look at the big chart. All right. Okay, so here is the big chart. This is the last year. Let's go down to 6 months. Okay. Now, I recommended this stock around here. It was selling for roughly $44 a share. I refer you to, and I'll put it in the description below, I'll refer you to the analysis that I did there, which was very detailed. I'm not going to go into that level of detail on this video, but there I talked about the balance sheet, I went through my rationale, etc. We looked at the free cash flow, which was $18.5 billion per year, which is enormous. And I gave my recommendation. The stock was like 44, now it's at 60. Okay? But this stock, it's gone through a number of different things since I recommended it. Number one, they brought in a new CEO, which was a major uptick for the stock. And number two, Dan Loeb of Third Point came in. He is a hedge fund manager, very smart stock guy. He came in and purchased $1 billion of the stock, and he has since been giving management suggestions, and he's looking for board seats and all of this kind of thing. He's an activist investor. That has contributed to the rally in the stock. But what I want to do is I want to go back to here, and let's really take a look at, because this is probably, the ones I'm going to talk about, this is probably the least damaged, because there's so much tailwind behind this stock right now. Is probably the least damaged, and it's also not overvalued. It was, when I recommended it, it was absolutely hated. Everyone on Wall Street hated it. Now a lot of people have jumped on the bandwagon, but you really want to buy these things when they're really hated. This one is not hated, but I think there's a lot of upside left in this stock, and it is a great company. So let's take a look, and I'm going to be applying some of my technical indicators here, and if you don't understand some of this, you can look back at a video that I did called Trade Stocks Like I Do, where I discuss these 5 technical indicators where I determine if a stock is overvalued or undervalued. But we'll talk about it here, and you can go back later and look at that if you want to, and you don't quite understand everything we're doing. Okay, so here we're looking at the Bollinger Bands, which is basically, this is the 50-day moving average. This is one standard deviation above and one standard deviation below. And this is a measure which will tell you if a stock is based on that 50-day moving average in the lower or upper end of its trading range. And it's very helpful in determining overvaluation or undervaluation. Here we have the slow stochastics, which again is a measure of, this is an oscillator measure, which will tell you if it was up here, as it was here, it's overvalued. Down here, if it's in this shaded area, it's undervalued. Again, I'm approaching this Intel recommendation more from a fundamental standpoint than a technical standpoint. So these indicators, as you can see, a week or so ago, I was touching the lower Bollinger Band, and we're heading toward being undervalued on the slow stochastics. This is RSI, relative strength. This is momentum, and this is money flow. But as I've said in previous videos, I focus mainly on these two, the Bollinger Bands and the slow stochastics. These are confirmatory measures down here. So we're in the lower end of the trading range, but we're not exceedingly overvalued. Okay? So on this Intel, what I would do on this is I would wait until it got to 58 for aggressive accumulation. Okay, so $58 a share on that one. All right, so let's go back to here. Let's go on to the next one. The next one is one of my favorites, and I did an entire video on this situation. where I was very bullish on it, and it's Airbnb. Now, I said on that video, which I would recommend, and I'll put it in the description below, I said in that video that I was also a host. I have a house in Vermont that I've rented out extensively on Airbnb. So I love the company as a host. I love the company as a user. And I think there is tremendous opportunity in this stock as a long-term investment going forward, or as something to trade. I wouldn't recommend trading it because the real value is going to be in holding this long term. All right, let's take a look at the historical chart. Came public near the end of 2020, and it traded up tremendously. Hit a peak in here close to 120. But over the last several months, and let's try to get a better look at this. Let's do the 3-month. Long ride up here, some up and down, but hit a peak close to 220, and now it's down to 180. Now, I said in the original video I'd be a buyer around 165. I did have a chance to buy it after I made that video, and I think 165 is a great price, but sometimes you wait for these prices to come up and you end up never buying it. So let's go back and we'll take a look at the technical indicators and see where it is vis-a-vis its trading range. All right. Okay, so we go here and we see, what do you know? 180 is at the lower end of the trading range. It's piercing or right on top of the Bollinger Band. You can see as it relates to the slow stochastic, it's at or near the oversold position. And if it got to 165, which is here, you'd be really oversold. So now it's oversold. And so I would recommend buying it here. I like it here. I think that this stock has tremendous potential. The market, the addressable market for this company is $3 trillion, and it has just scratched the surface. There is a lot of runway to go with this company. It's well managed. It's well set up. It is a technology company in the sense that they don't own any of these properties. They are the middleman in between the host, which is me, and people that are wanting to rent. I think that the fundamentals are very strong vis-a-vis the rest of the hospitality market, simply because during the pandemic and post-pandemic, people are going to want to rent an individual, discrete unit to avoid, crowds or interacting with a lot of people. I think that trend will continue, and it's just great. When you want to go skiing or go to a vacation in Florida or really anywhere in the world, it's great to rent an entire house and have your family come with you, and it's so much better than being in a sterile hotel room. And so I am very, very bullish on this stock. Okay, so let's go on to the next one. Now this one I just started focusing on, and it's going to surprise you because it's not purely a technology stock, and this one is Moderna. Okay, now as you probably know, Moderna is one of the 3 companies that came out with vaccines for the pandemic, and they have one of the leading vaccines. Their technology is different in the sense that it affects messenger RNA, which actually alters your genetic material and makes you more resistant to the proteins on the outside of the virus. Let's not get too technical here because I'm not a scientist, but they have a very unique methodology of doing this, and I did a little bit of research. They are working on, and they're in preliminary trials right now, I think phase 1 trials, of a cancer vaccine. Now, this is revolutionary, mind-altering technology that takes a vaccine and what they do is they actually measure a person's genetic material. They look at a person's genetic material, they map it out, and then they take that person's specific cancer cells from their tumor. They map out the genetic material on that person's individual cancer cell, and they map it out and they match the virus specifically to identify the gene mutations within the cancer cell and identify it to the body's immunological system, and the body's immunological system attacks the cancer cells. I mean, this is insane technology. Instead of a pure tech play, this is a biotech play, but it still has been tremendously impacted by the sell-off. And I think that this company, the virus alone for the current pandemic is reason enough to buy it, but then they have this mind-altering vaccine for cancer, which could change the treatment of cancer fundamentally and save many, many lives. And of course, if they can complete this and get FDA approval on this, they are going to make an insane amount of money. Now, the other way that I look at this is if they get this through the trial successfully and get FDA approval, one of the bigger companies might buy it, like Pfizer, Merck. They might buy it because they want to get the technology, all right? They want to get the patents. So I think that from a fundamental standpoint, just looking at the company, and a potential acquisition candidate, this company really excites me. And my wife likes it too, so that's a good sign. She's got a good intuition, even though she knows nothing about investing. That's not a cut. She's a very smart woman. She just doesn't have an interest in investing. She leaves that up to me. Okay, so let's take a look at this. That was a long-winded explanation, but let's take a look at this. Let's look at the chart. You can see how beaten up this was, or is. Okay, now, if we look at the 3-year chart, you can see it only came public, at the end of 2018, beginning of 2019. So it hasn't been public for that long. So here, look, 2021, it was in the 110 range. It went all the way up to 180, and a little bit over 180. And you can see, whoa, it went all the way down to its current price of 132. Okay, so it's really sold off a tremendous amount in the face of developing the successful vaccine for we'll call it 𝐤, and beyond that, what they're working on with the cancer vaccine. So it's gotten beaten up, and it gives us an opportunity to go in. Now, let's take a look at where we would go in on this thing. What do you know? It's right at the Bollinger Band, and it's deeply in oversold position on the slow stochastics. And if you look at the confirmatory measures, the RSI is approaching oversold. Momentum is oversold. And you can see the money flow is negative. So all things are pointing to buying this stock from a technical standpoint. And I think this is very exciting. As you can see from this chart, I'd buy it right where it is now. Okay? 130, 132. I'd buy it tomorrow. In fact, I'm going to buy it tomorrow. Even though I think the tech sector and maybe even Moderna is going to get beaten up maybe more because tech wreck is not over yet, okay? Tech wreck is not over. There's going to be a lot more damage, but you know, you don't often get opportunities to buy stocks of this type with this much potential. You don't always get a chance to buy it at these attractive prices. Okay, so the next one up here is none other than DraftKings. Yes, I did an entire video on this one, and I went into tremendous detail on it on that one, so I'll refer you to that one in the description below. But DraftKings is basically fantasy sports and online gambling. They have a first mover advantage in this market. There are only 11 states that currently have legalized gambling on sports. And I think with the, pandemic effects and the budgetary pressures that many states have, there is tremendous growth here for DraftKings with respect to future states legalizing it and allowing sports betting vis-a-vis the internet. So I'm very bullish on this. I think there's a tremendous amount of growth potential there, and so that's why I like it. If you want more information, just check out the video that I did on it. So let's take a look. Let's see what has happened to this in the market recently with the tech wreck. This is the 1 year chart here. Let's go 3 months. Yeah, 3 months is good. All right, so beginning of 2021, it was down around $45 a share. It went on basically an upward ride, bounced around a little bit here, but then it shot up. And the reason it shot up was because they entered into an agreement with, I think, Dish on being the provider of sports betting directly to Dish. And that created a lot of excitement in the market. So it gapped up to, close to 70. And then this past week, it went down to around 60. And it closed on Friday at 59.52. Okay? Now, when it shot up like this, I was like, oh, damn. I'm not going to get a chance to jump in. But the market and the recent sell-off has given us an opportunity. We're down at 60. Okay, so let's take a look at where we are with the technical measures. Okay, let's go here. All right, DraftKings, look at this. Okay, so you can see it sold off, and when it was getting close to 70, it was overvalued. It was overvalued with the Bollinger Bands and also with the slow stochastics. You can see these other confirmatory measures had it overvalued also. Selling down to 60, it puts it right about at the a little bit below the 50-day moving average, okay, which means it's going in the right direction. So if we want to buy this stock, which again, I'm looking very, very strongly at buying some more of this. I bought some when I recommended it originally when it was down, I think in this level, right? But what I'm saying now is I think $55 a share is where I would be looking to accumulate this aggressively, okay? So $55 a share on DraftKings. Okay, let's go back here. Now, my last one is an index that I've talked about on previous videos. It is none other than the 𝐥𝐤𝐞. Now, what is the 𝐥𝐤𝐞? If you don't know what it is an ETF that mirrors the NASDAQ 100. Okay, and so this is really a measure of the NASDAQ 100, which includes all of the major mega cap tech stocks. Now, if you want to, just play the tech wreck in a way that you don't want to be bothered with individual stocks, And, let's face it, individual stocks are more risky. This is a brilliant way to play the tech wreck, and you don't have to think about it so much, but yet you're basically going long all of the major tech stocks by going long this position. Okay, let's take a look at historically what's happened here. And it basically tracks the NASDAQ. And you can see the level of devastation, but it was coming from a very, very overvalued position here. Let's go a little bit further out, 9 months. You can see it steadily went up. If we go back a year, you can see April, it was down around 180. And that's when it first came on my radar screen. Unfortunately, I didn't really buy a lot of it at that point, as I should have. But in any event, it's never too late to get on the right track. And you can see enormous damage. It went from 335 down to where it is now. It was in and around 300. It's a little bit higher than 300. When the market was selling off last Thursday, this thing got slightly below 300, where it was extremely oversold at that point. Now, I want to preface this by saying that there is going to be more damage in the market, but you're not going to time the market exactly. You're never going to time the market exactly. The tools that I'm giving you on these videos are, about the best technical science that we have available to us as retail traders. And the pros use this stuff too. So let's just take a look at the technical measures. Okay, here we are. We can see pierced the bottom of the Bollinger Band last week. That's what I was telling you about when the market was extremely oversold. The Dow got down to was minus 700 at one point. That was the day this got this much oversold. You can see slow stochastics oversold. Virtually all of these indicators are indicating that this index, it's an ETF, but it's really mirroring an index, is in an oversold position. So if you are a long-term investor and you are looking to take advantage of this tech wreck, you could buy it here or you could wait for it to go lower, but I'm thinking that this is a point in time when you would either want to go long the ETF directly or you would want to sell puts, naked puts, but that is beyond the scope of this particular video, and we'll save that for another video. All right, so those are the 5 recommendations. Let's go back to the main screen and we'll discuss again what we're looking at. So I hope you liked that little trip down memory lane. These 5 opportunities are opportunities that are presenting themselves now. Could they go lower? Sure, they could go lower. Am I giving you financial advice? No, I'm not. I'm just telling you what I am doing, the way I look at it in my, close to 30 years of market experience and having worked on Wall Street for a long time. So I think with respect to some of those technical indicators, I would recommend that you take a look at this recommended video right here. This is where I talked about and went into detail on all of the technical indicators that we spoke about in this video. Trade stocks like I do. The other one that I'd like to point you to is how to, how to profit from the tech wreck. That was recently done. You see that up here. I'm going to also put a video in the end screen at the end of this video so you can take a look at that. Now, what does this all mean? What this means is, and what I think is, that we have longer to go with this tech sell-off. There are things going on in the bond market right now on the long end of the curve that are telling us that there is trouble brewing in the bond market, And that is going to factor very prominently into what's going on in the stock market. I think it's discounting inflation, and I've said that before, and I've also expressed the opinion that I think Powell is behind the curve. He's trying to be politic. He doesn't want to trash Biden's pork-filled stimulus extravaganza. He wants to keep his job, so he doesn't want to criticize it too much. But I think the combination of the porkathon coming in and also the economy just repairing itself naturally. I think you have 18 states right now that have done away with the restrictions and are opening up, and many, many other states are considering the same thing. So the natural pent-up demand and the natural strength and depth of the U.S. economy will naturally take us out of this thing. And I think giving people money that don't need it and extending unemployment out ad infinitum is only going to slow down the recovery, because in employment, which is what they say they're concerned about, because it's going to keep more people sitting at home playing video games and watching Oprah or whatever they're watching on TV, and not going out and getting a job if they don't need it and the government's just shoveling out money for them. So anyway, that's my opinion about that. So look, I hope you found these ideas useful. And there, like I said, there's going to be another idea coming up shortly, another video that will tie in with this. And I hope you got some value out of this. If you got value out of this, please like and subscribe. It's very important that you subscribe so that you can be on board for future videos that I put out, where I give specific ideas and I tell you my rationale for them. And the purpose of this channel really is to look at the market, or the markets, because we do talk about the bond market, and read the tea leaves, so to speak, try to interpret some of this to be valuable to you so that you can be a better investor and you can make a lot of money. Because after all, that's a good thing. And that's something that we should all want to do, and we should all want to do it in a way that benefits everybody. Okay? So thanks again for joining. I appreciate it, and stay tuned and subscribe so you can be on board for future presentations, which will be coming your way very soon.